Good morning, members. Many would have been thinking why morning happened, but it's not in our control. It has to happen after night. Morning has to happen. So I hope everybody enjoyed thoroughly the previous days' deliberations, and after deliberations, whatever we had throughout the evening. So welcome back to the last leg of this ARRC, the last day. Today we have three speakers. To start with CA P V Srinivasan. He will be taking us through this tax risk management in international taxation, and followed by other two speakers from Mumbai. CA Bhaumik Goda will be discussing on section 94B, limitation of interest deductions. And finally, we have CA Ganesh Rajgopalan, who will be talking about significant economic presence and digital commerce taxation. This will go up to 1:30. 1:30 to 2, we have a valedictory session, and after 2, lunch and departure. So the lunch will be provided from 1 o'clock itself. So if any person would like to leave early to catch flight or trains, from 1 o'clock the lunch will be available. Yesterday we had a group photograph which we have got it framed. Everybody has been framed in that group photograph. Started distributing early. Now the latecomers, you can collect it afterwards. So as we are starting with the first session, CA P V Srinivasan can get into page number 173 and 174 for his detailed biodata. I know P V Srinivasan from 1998. Before he joined Wipro, I was working for Wipro. So I was a external auditor. Then he joined Wipro. From that day onwards, I know P V Srinivasan, very humble person, a down-to-earth person, and he has helped me in so many ways, not only technically also, but I do a lot of work for Wipro. He was there hand-holding me in my initial stages of practice. A very humble person, very down-to-earth person, I should say. And whenever we call, he'll readily accept our invitation to come and make presentation. He has got very wide experience in Wipro. He was heading the Wipro as a corporate tax manager, and he has traveled across the world, and he has got hands-on experience on international taxation. We do local international taxation, but he does international taxation. We sitting in India, we only do one-way international taxation. So he travels across the world, and he has got a lot of experience and exposure on international taxation. Today he'll be taking us through this tax risk management. Of course, for every country, the risk is taxation. From the government perspective, from the investor perspective, also today the risk is tax only. Because if you go through his presentation, he has given a lot of tax risk events that happen, especially in our country. We have what you call this retrospective amendments, prospective amendments, amendments in between, and also interpretation of law. So when anybody would like to come and invest in a country, he has to go through various aspects of taxation, because for non-residents, tax is a cost. For residents, tax is an obligation. So to take us through more on this tax risk management, I welcome P V Srinivasan sir, and I'll like to call upon Jugal, sorry. Jugal is my son's name, that's why I immediately said Jugal. To welcome P V Srinivasan sir with a pen book. So Jugal said he wants to leave at 12 o'clock. So that's why I called him. I told him to have lunch. I said, no, don't worry, sir. I'll have lunch, breakfast, and maybe dinner also. Together, maybe we would have grown 1.5 kg more. He has completed everything in the morning itself. Breakfast, lunch, and dinner. Sir, what do you?
Good morning. Good morning. To do a session on Sunday It's not a most pleasant exercise. All of us are in some kind of a holiday mode. Possibly we don't see a risk at all. Now we want you to see tax risks. I think that is the most difficult part. We'll do some justice to the subject wherever. So how do I get over this picture, Bhaiya? I just switch it off. I will try and make it as simple as possible. The presentation may look somewhat complicated when you look at the pages 173 onwards. As CA Srinivasan was saying, we will try and make it as simple as possible. Okay? The idea is not to see. I think if I have to say, you must have also discovered international taxation. If you have one speaker who is at the beginning, he can be exhaustive, he can cover all the subjects, so he can make the other speakers virtually redundant. So is the case that if you leave it to me, I can make other speakers redundant because the topic can be exhausted in such scheme. So we will try and narrow down our scope to such a way that we deal only with tax risks and how you can mitigate them, what is being confronted today, what will be the future course of action. This is a chart you will always see in my presentation wherever I go. I always say that what is the purpose of business existence as we understood for ages is the stakeholder or shareholder's wealth maximization. That's where you start. It has two aspects to it. There's a business flow and there's an investment flow. You augment your investment in international taxation in a particular way. You have regional holding companies, you have got step-down subsidiaries, you have got holding structures, you will have an IP company, you may have a finance company and so on and so forth. You do all that and they are all part of the investment flow. Then there is a business flow because you have got transactions between entities, you will supply goods, you will supply services, there may be royalty flow, there will be dividend flow, there may be interest flow and so on and so forth. Those are all called the business flows. So on the one hand you have got an investment flow, on the other hand you have got a business flow. The investment flow is called the holding structure and the investment flow is normally understood as the supply chain. So what you have as a supply chain is what you control through transfer pricing, and investment flow is driven by three aspects as to how you will derive the interest income, how you will derive the dividend income and how you will derive the capital gains. So this is the way the businesses are carried on all along, that I will have an investment flow which gives me the wealth which is maximization. Ganesh ji, good morning. Good morning. So, welcome. Bhaumik ji, welcome. Yeah. So, you have on the one hand that the shareholder maximization is done through two arms. One is the investment flow, the other is the business flow. The transfer pricing regulations have been controlling the business flow, and the holding structure related aspects have been controlling the investment flow. What has changed now is that now you have to balance the wealth maximization. Earlier it was not that it was wholly free, but it was enabled. Hundreds of treaties enable you to do what is called a proper planning of your investment flow and a proper planning of the investment flow, business flows. Now you have suddenly find that you have to overlay the entire thing with this what is called the tax risks associated with wealth maximization. You cannot achieve wealth maximization unless you have managed the tax risks also equally well. So tax risk management is an integral part of wealth maximization. You cannot have a permanent wealth maximization unless you have managed the tax risks also quite completely. In the transfer pricing regime, possibly you have already heard it or you may hear it while going forward. There are intangibles which have come in place, and most businesses are driven by intangibles. Intangibles which you recognize as intangibles which you don't know even that it exists and they are existing in the marketplace. So you find that suddenly your transfer pricing regulations, you have to now be confronted with a new animal called intangible management, and the intangible management as an integral part of transfer pricing, and you have to manage that is the outcome. So two events have taken place, that you cannot have an investment flow without knowing that whether it maximizes the wealth or it diminishes the wealth over a period of time. You cannot have a transfer pricing regulations which are without understanding where your intangibles are, who are the contributors to the intangibles, and the intangibles have to be valued, how to value, what is the contribution in the relative value chain. So supply chain suddenly has become what was earlier understood as functions, assets and risks. Now suddenly you start looking at functions, asset, risks and marketing. Another element has got added to it. One can say marketing is already embedded in the earlier three. You have to understand the functions, assets and in the assets, marketing could be one of the assets, and risk evaluation could be one of the evaluation of marketing risk. But now you find that markets have become a dominant force in the entire transfer pricing analysis, and you cannot ignore markets all of a sudden. So supply chain has become a market chain, if I can put it. So you find a change in the constitution of how you understand the tax risk. Investment flows cannot be what it used to be, supply chain cannot be what it used to be. This is the change which has come about in the entire perspective of tax risk. Then came BEPS. I will not talk too much on BEPS, you had already heard it. These diagrams, pictures you can go through later on, but essentially to capture the thought, BEPS came, there was a furor that companies are earning a lot of profits, they are not paying adequate taxes in the perception of public, not in legal terms. In public perception, they were not paying adequate taxes. BEPS action was done. OECD and G20 came with a lot of recommendations. Almost 100 countries participated in the BEPS program, and you find that after such a global consensus, 15 action plans points were formulated, and amongst the 15 action points, you find this is the table which may be useful for you, which comprehends as to how the 15 action plans, what they constitute. We will not again deal with the 15 action points, which is a separate exercise. What we need to point out is that there are certain action plans which prevent abuse. There are certain action plans which bring about transparency and certainty. There are certain action plans which look like coherence, and there are certain action plans which want substance, and there are industry specific action plan which is the digital economy part of it, which has not, the recommendations are not complete, but we are in the progress towards achieving it. So the digital economy is incomplete, but still we have some roadmap as to how it will be achieved, but we have got other 14 action plans which are already implemented. So you find that now we cannot do anything unless there is transparency and there is certainty. We cannot do anything unless we have sufficient substance. We cannot do anything unless there is coherence about the transactions and execution of transaction, what is called the conduct versus agreements. You may have an agreement, but if the conduct is not as per the agreement, then the conduct will be overlooked and the agreement will be subordinate. This is what should have been always. It is not that it should have been different earlier, but the emphasis now has changed to look at the conduct of parties rather than only the framework on which the agreements have been constituted. The most important part, which is as action 6, 7, prevent treaty abuse, prevent the artificial avoidance of PE status, and last one, 8, 9, 10, you find that it's about artificial transfer pricing with overlaid with value creation as an aspect. What is value creation? Still there's an understanding to be done. There's a perception as to what value creation is. How ALP was not meeting the value creation criteria, or whether it was misunderstood as ALP. Now we want to find the real ALP. That's what we have to possibly look at as we go along. So you find the distortions have taken place in the international framework. Unless there is substance, you cannot do the transaction. Unless the value creation aspect is met, you cannot have a supply chain which meets with the ALP criteria. And there are certain other aspects which have come to limit your amount of exposure. For example, you cannot have an interest deduction for which you will have a separate section next. You can have a significant economic presence. My next speaker is going to speak about, which is again about PE constitution in an international framework. You will have a different criteria. So all this, you find that the dynamics have changed, if I can look at it. Even the PE criteria has changed. You suddenly find that you cannot be a dependent agent criteria, that you could conclude all the activities except conclusion of a contract, which was good enough earlier, it is no more good enough. If the activities constitute a substantial part of contract conclusion, then you cannot draw a line that this contract is not executed. DAP related, the fragmentation issues, all those things have gone away. Now all those things will be redefined either in treaties. Of course, the framework is already available in international parlance. The domestic law supports that kind of a anti-avoidance mechanism. It is the treaties which need to be revised from time to time. They will not get revised over a period of time, either through a MLI process or through other bilateral processes. So what is tax risk management? These things, if I may have coined it in terms of, say, theoretical exercise, but in reality, this is what actually tax is. How we are assessed as tax managers. Normally, a corporate employer, if you are head of the company, they will assess you on 3 or 4 parameters. I can say I was assessed on ETR. What is your ETR? Are you better than the ETR of competitive companies in the relative space? This is a very common measurement across industries. If competition is ETR is 20 and your ETR is 22, that means your structure is not good, or you are not done well in computing your taxes, or your allocation issues are not proper. Something is missing that you have not sized it, which the competition has sized it. So your ETR is a clear indication whether you have done well or you have not done well. Again, if the ETR is too low, suppose the competition is 20 and your ETR is 15, then possibly it reflects that you have taken a little more aggressive positions than what the environment would allow. You have to revalidate your position. Even today, as we speak, ETR is a good guidance because that possibly will reflect as to how the collective conduct of people is. If the ETR has moved from 20 to 22 post-BEPS, you can presume that people are shifting the needle, that what was 20 was possible area, suddenly it has become 22 because there's a reconfiguration of the entire structure, there's a reallocation of pricing which is happening. So ETR is a good indication of tax risk management. You know how your competitor has managed it, you get an indication whether you are aggressive or less aggressive, and accordingly you get a mirror in front of you to know how you should manage your taxes. So I will say ETR continues to be a good measure. The second indication of a tax risk management is you look at the tax. ETR is the only representative as far as the P&L is concerned. All others are balance sheet related. For example, if your cash tax is higher, then again that means you are paying disputed taxes, but it is not reflected in the ETR. That means you are waiting for a lot of refunds from the department. A refund from the department, no matter which government it is not going to happen very easily. So, if you have got a cash tax which is higher than the competition, you presume that you are paying out money, but you are not counting them as your liabilities. You are not sizing your liabilities properly. You have got a high risk gain, and that also is not a great indicator. Cash tax to in a comparison scenario can be the third one. Third one is the constitution of your balance sheet. You have got 3 or 4 assets on your balance sheet. What is that? It will be, one is advance tax, number 2 is TDS, number 3 is MAT, number 4 is other foreign tax credits and other things which you have got entitled to for a moment. You find that all these assets which you classify in the asset balance sheet, you have to constantly validate whether they are good assets or bad assets. So, a balance sheet construct also is as important as to how much of tax assets you are carrying compared to your competition. If your tax assets compared to competition is lower, that means your balance sheet is stronger. If your tax assets compared to competition is higher, that means you are taking higher risk with your tax assets. Tax assets are always vulnerable. For example, if you have got MAT credit, you would have quantified the MAT credit in a particular way. You have got a deferred tax asset for a moment. You would have quantified the deferred tax asset with 30% or 35% as the underlying rate. Tomorrow the corporate rate comes down to 25. You will have to write off the deferred tax asset to the extent of 25%. Any balance sheet which is liquidated on the balance sheet side of the all the tax assets are liquidated, a leaner balance sheet is more healthy compared to a stronger balance sheet on tax assets. Otherwise, the tax balance sheet may be strong, but a leaner balance sheet on tax assets is better than a stronger balance sheet. For example, if you have got a MAT credit which is very large, that means you are leaving a legacy for your successor to manage a credit which he may not be able to manage. Tomorrow the government is not going to give you tax credit, MAT credit easily. They will say, to the extent of MAT credit avail, the tax rate goes up. So you will be liquidating yourself without it doing anything. So you have to find out what is the balance sheet structure as you sit along. These are traditional risks, they continue to be traditional risks. What has happened is, all the balance sheet assets which you have quantified in the past, they were all quantified with a particular risk structure, a holding structure, a supply chain, and so on and so forth. Suddenly you find that those are not anymore good, so you may have to write off some of your balance sheet structures also, because if you get an intangible, say, BV Islands, and suddenly you find that you cannot transact with BV Islands at all, any asset which is relating to BV Islands, you will find that is no more good enough, you have to liquidate those tax assets immediately. So your transaction flows change, your balance sheet will change as the going goes. So I would look at saying that timely and effective compliance is one of the aspects of tax. I have talked about how a manager looks at ETR compliance. Quarter to quarter when I look at, these are the metrics I would look at and feel comfortable that I am either on par or I am aggressive, that kind of a mechanism. You will also have to do the same thing in your own industries as you go. Documentation. People look at documentation in a mechanical way. Say I got a good documentation. This documentation is not a voucher. Documentation is superior to voucher because a voucher evidences a transaction. Documentation evidences the structure and the flow. Unless you have got a documentation which evidences the structure and flow, you should not confuse it like a voucher. Every voucher may be supported by underlying documentation. That's fine. That's a voucher. A documentation is a higher understanding than a voucher. A documentation has got two capabilities. One, to understand the transaction as it is at the point it is concluded, is contemporaneous understanding of the transaction. Number two, ability to retrieve it when it is required. The first one we all will possess. We all understand the transaction, we will document it properly. But at the point of retrieval, the person who created the document is not there, or the transaction is now understood in altogether different focus. You will find that's a change. So I would urge that the documentation should be so nicely placed that it has a common understanding, at least till you cross the assessment stage. Because today the greatest difficulty of most corporates is that ability to retrieve document rather than to create document. Most corporates are not in a position to retrieve document, they are in a better position to create document. So I would suggest a documentation which has an archival and retrieval mechanism, and that is the one which I will say. So documentation should narrate the transaction correctly. The person who retrieves also must be able to understand it in the same context. So that is document. So you must build strategies for defending it. At the point of creation itself, you must know how you are going to defend it. If you don't have a defense strategy at the point of creation, lateral thinking, when the point comes, that is all tactical. A tactical answer wins sometime. A tactical answer very often may not win in the long run. I would as well find a mechanism that this is my structure, this is the flow, this is how I am going to defend myself, and the defense document should be created upfront. Thought leadership, very important not only in India, globally. If there is a tax policy which is adverse to you, or it is being created, you must participate in the government and ensure that the tax policy comes on the scale which is acceptable to you. So I would say participate in thought leadership, participate with governance issues, be critical if there is a poem circular for a moment, the government notifies, we are all invited to make contributions to that session. Make constructive contributions, you will be heard. Most governments will hear you and then possibly evolve the final document. It's true internationally. And I can say I have participated in law formulation even under IRS, under the US regulations. You are right, saying that this law, particular law, I do not know. For example, California had a unitary tax system, that the global income itself can be taxed in California. You write to the regulator that your unitary system is not correct because it is trying to absorb things which are not possible. It is not intricately related to the economic activity. You must avoid the unitary principle. They will accept, they will not accept. But have a mechanism to write to the regulator saying that this is the law, this is a flaw in the law, you must adapt it to the regulatory framework which is norm internationally. So I would say that tax management risk must look into all these aspects which I have talked about, and we will now go into a little detail as to what causes the tax management risks in tax planning. We will talk about management later, but what contributes to the risk, then you can possibly manage the risks also. Ambiguous law. Law will be always ambiguous. It is nothing to, I will tell you, no matter how good English is written, it will be ambiguous. So, two things we must learn as we go along. A litigation strategy is different from a planning strategy. In litigation, every comma, full stop needs to be interpreted, we will interpret. But in planning, to start interpreting on comma and full stop is not going to take anywhere. So I would suggest that take a course of planning that more often than not, you will win. Suppose, despite doing all that, you are caught unaware and your interpretation is found to be wrong. That is the stage when in litigation you always take what's called very controversial arguments and try and defend your positions to that extent. But to start reading the law itself on controversial positions and then start interpreting and taking extreme positions that I'm going to win on those, the probability of doing success on this is going to be very limited. Don't take extreme positions. Take actually the breadth of law. People who are extreme practitioners will tell you that take the narrowest path and interpret the law while planning. Take the broadest path while interpreting in a court of law. So the scope is that if you fail from here to here to here to here, finally if you happen to fail, you will be where you want to be and you will not be beyond that scope. So while interpreting in the court, you have this as a scope, but while planning, you have this as a scope. So that the channel of passing through that channel in the eventuality is almost certain that you will not fail. So you must have the scope that I will plan for certainty, but I will maximize for arguments. Unilateral measures is again a problem. You have got a 115O. What is 115O? Reverse the tax in the hands of the shareholders into tax into the hands of the company. So what would have been a shareholder's tax is now converted into company's tax. No, this is not an international norm. 115 QA buyback tax. So unilateral tax measures now beat in the US, where it says that any payment made to a non-resident for availing services from related parties, then certain portion of the expenses will be disallowed. So the effective tax rates will go up. This is what BEAT is all about. So unilateral measures of any country will enhance the overall tax risk. Retrospective amendments, Kota did mention that retrospective amendments are something which catches you unaware. You do not know whether you will be visited by it, but nevertheless you are visited. This is a huge tax risk, and people know that this is something you cannot do much about it, other than say that retrospective, after retrospective also it is not retrospective. That's the way. So these are all very common interpretations. We will leave it to those aspects to the lawyer. The moment a retrospective amendment comes, no auditor is going to sit in judgment and say whether it's a valid law or invalid law. The moment a retrospective amendment comes, you are going to visit it with a tax liability. He will ask you to make a provision in the books. ETR changes. The moment ETR changes, your evaluation changes in the company. So your evaluation metric is already crossed at that point in time. Look back provisions, not due to principle of provision. What happens? For example, I will give you. Many of us are used to reassessments. In a reassessment, there are multiple thresholds of limitation. There's a 4-year limitation, there's a 6-year limitation, there's a 16-year limitation. When the look-back provisions are so vast that it can go back to 16 years, then actually the risks go up accordingly. Because 16 years later, even transactions which you have documented well, which you have preserved well, you can pull out from an archival, but the transaction memory will go out of the people at that point in time. So how to present it, what to write, what were the intents of the transaction, or how it was constructed at the point it was constructed, the historical knowledge will go out of you, because organizations, though they are not like natural intelligence will not be there, organizational memory is also very, very high. That's called, if I don't know, but my colleague will know why a particular transaction will know. If there are no colleagues around after 16 years who knows the transactions the way it was constructed, then you have got a problem. Again, our look-back provisions have a scope which is very vast. If a particular financial interest transaction in international consequence is found, they reopen the assessment on that score, the assessment need not be limited to that particular issue. It can travel to all the issues beyond that also. So the look back provisions can be a huge tax risk. So your tax risk management now boils down to, if you are picked up for assessment, or even if you are not picked up for assessment, you are filing an electronic return, what are the kind of disclosures you will make upfront now and take the problem immediately rather than wait for the problems to be visited by later after 16 years. So assessment management is becoming a very important task. What normally you will not submit to the assessing authority, saying that let him ask, I will submit, now have become that whether he asks or not, I will submit. I will ask him, provoke a question in him, I will submit answers to him, so that my ability to get a reopening opportunity comes down as and when. So now assessment framework has changed. Earlier it was, I will tell you what is necessary, what you ask for. Now the assessment proceedings is, I will tell you whether you want or not. So manage your assessments in such a way that you make more disclosures than what you would. Answer the questions today, don't postpone the questions for tomorrow. And formulate your assessment strategy accordingly. It has got nothing. If your objective is to be above board and you have got an interpretation which is going to support you, there is nothing wrong in telling the assessing authority, except that our authority may not be immediately matured enough to receive it. He may make an addition. You may lead a little amount of litigation to win your case, but you are better off on doing this than being visited with a 16-year later notice on an issue which you may not even know that you have got. So create a record which will possibly help you. So look back provisions are the most dangerous ones which you have looked into. Adversarial environment. If you are in an adversarial environment, no matter what your tax strategy is, no matter what your merits are, nothing really bothers. If you are part of a tsunami, you will flow the tsunami. If there are tax demands raised on assessees, you will also get a tax demand. Don't bother about it, you will get it. It's not that you will escape it. So if you are part of adversarial environment, you will suffer the environment. But I have always seen that the environment always changes with forums. With a lot of experience, I can tell you, I have never found one chain which is a complete block. What is a chain? You start with an assessing authority, you go to the Commissioner Appeals, you go to the tribunal, you go to the High Court, you go to the Supreme Court. I have not found a single time when all the authorities were wholly against assessees or all the authorities were wholly with the assessees. The chain always had some turns. If your tribunal is with you, High Court maybe actually will be against you. The trend, I am not talking about individual merits of the transaction. The trend will be like that. You will find that the High Courts today are more beneficial to assessees, while you find that the tribunals are not as beneficial to assessees. Today this is the trend. You find it more difficult to win in tribunals than you will find it in the High Courts today. This is the trend today. This trend will change tomorrow, that High Courts may become more difficult and tribunals may become easier for you. So I will say, place your merit. Environment issues will affect you, but your merit will eventually win, and keep the arguments tight and hold on to it. Ineffective segregation of responsibilities. Very often.
This jurisdiction-less assessment is good.
I talked about it. Very no. Jurisdiction-less. Assessee's jurisdiction is there. Assessing officer's jurisdiction is not there.
Why is it going to be a reality?
I got one particular line on that. I'll deal with that. That's all. Ineffective segregation of responsibility. In organizations, we have got silos. It is very common that tax man is actually below the line even in the organization. But the reality is nothing to do. We are below the line even in the organization because the transaction is completed, it is recorded, you are given a what's called a faith accompli. You don't get any kind of a participation into it. So whatever comes from the other teams is what you inherit, that's what you have to defend also. A little change. CFOs have become more and more now concerned with tax consequences. You try and see that the ineffective segregation of responsibilities within the organization comes down a little. Likewise, even in the department, there's an ineffective segregation of responsibility. If a 148 notice has to be issued, It is not that the commissioner is already, commissioner is in the equal wavelength as the assessing authority. Both of them want 148 to be issued, that's why they issue. It's not that they have, the CATA exercises a differential, it's a mechanical exercise of judgment rather than an applied sense of judgment. So you have got two problems. There is no segregation of responsibilities in organization which is effective. There is no segregation of responsibilities in the department also. It is universally true. I can tell you it is nothing. Even in the United States you go, the inspector wants you to be investigated by a higher authority. You will be investigated no matter what kind of justice system they have. So the inspector possibly decides the outcome of what the environment will be. So you don't expect, you go to Japan, you go to any country, usually the inspector defines the role of the rest of the organization in that protocol. Invasive proceedings, you will have surveys, search, etc. We must have a strategy. These are all going to be common because if they suspect that you are hiding documents, you will always be visited with surveys. To earlier, the surveys, searches were for the purpose of searching property. You may find that for discovery of information also there will be surveys and searches. Okay. Earlier they wanted undisclosed properties. Now you may find that the survey and searches are taking place for discovery of information, nothing more. Tax accounting and tax and accounting statements, I mentioned also what are the different aspects you must look for. Enhanced tax risks have come also because of certain, what's called, all governments want to enhance foreign taxes. They don't want to enhance domestic taxes. They want collections from foreign taxes because domestic taxes is nationalistic. They go into the voters' bank. They become the constituency in itself. So everybody would like to enhance the kitty of foreign taxes. So that means a transaction generated from outside the country should pay more tax than a transaction generated within the country. So this is a universal law. Let us not get too buried with India as a term. I can tell you globally this is the phenomenon. Right to tax is now shifting to fair tax. That is, what is legally right earlier is now become what's called fair tax. That is something which somebody will perceive to be fair. So you cannot say my yardstick of law I have met, I have computed correctly, my risk questions are correct, this is the amount of tax. Right tax is now shifting to fair tax. What is the gap between right tax and fair tax? Right tax can be quantified easily. Fair tax is a perception. A perception can never be met. So nevertheless you don't go all the way to fair tax, you but move away from right tax. Come to a level of tax which is between fair tax and right tax. Strike a balance that you are able to manage your overall taxes within acceptable. Now corporate governance is now extended to tax governance. Many companies have started reporting their tax policies. In fact, the UK, I understand, has got a policy that you must put your tax policy on the website. But what is your website, what is your tax policy, how you are taking conflict into, what is the integrity, what is tax, everything has been out. Vodafone has put already one document which is about 90 pages. You may be able to get that document. You can have a look at it. You find that now, if it's a new space, now everybody would like to say, call themselves holier than the other. If I will put a tax policy saying that my integrity in taxes is the highest, what that integrity will be tested only in real times, but the claim will be that my integrity is very high. Make proper claims. Don't put exaggerated statements. These are all evaluated at public at large. Only when the adverse event comes, that statements get validated. So have a responsibility. Don't do anything gimmickry with those disclosures. International consensus on BEPS. Now MLA has become a reality. You would have studied MLA possibly in the last 3 days. It's become a reality. Significant economic presence. My learned speaker will speak a little more. Now also has become a new constituent of permanent establishment and business connection. So we have to understand business connection, permanent. So all the old understanding, when they say investment flow, we understood, and a little amount of business flow, you have to suddenly find that you never thought you have got a PE. Now you find that you have a PE. So you will have to understand the investment flow a little more differently. Transfer pricing aligned to value creation. I talked about greater transparency, the new norm, and everybody wants to be appearing to be showing more transparent than others. That's a competition in transparency. But what is transparency is not actually, excessive disclosure is not transparency. We have to understand the difference between transparency. I can give you a bundle of newspaper every morning. That doesn't mean transparency. Transparency is a capture of one essential feature of your policy, which will essentially reflect thought across the organization. If I say I will not do tax evasion, that thought should be reflected across the organization in every step, that nobody will practice tax evasion across the chain. That is transparency. I cannot say that the leader tone on the top is that tax evasion will not be there, but downstream everybody will be practicing tax evasion. That is not transparency. That is misstatement. Transfer pricing aligned to exchange of information. Today we are in a global world that information is available to everybody. If you think that you are the only one who is clever, you have got possessive, you have secretly kept the documents, what you are not able to retrieve, the department will retrieve. That's the reality actually. You may not be able to get an investment document from your records. The assessing authority already has your investment record in overseas entities. Okay, that is the international flow of information. There are institutional flows, that is called CRS and FACTA. They are institutional flows that financial institutions share information about investments and investment flows across jurisdictions on an automatic basis. Then we have got exchange of information through tax exchange information exchange agreements, and now we got CBCR. Country by country reporting also is an exchange of information program that your entire structure as to how you have looked at the risks and resources is now upfront disclosed by you. All that the tax authority has to do is to validate, number one, believe you that you are right, then prove that you are not right. These are the only thing he has to do, that what you have stated in your document is what you have claimed, but actually what you are doing is not what you are claiming. Alter the equations and then make a reallocation of profits according to what he wants. So CBCR is a claim that this is how you are seeing your risk, and all that the authorities has to do is that how you are seeing your risk is not the correct way of looking at it. You should look at it differently. So you will allocate different profits at different points of time. So these are the new frameworks of exchange. So any international today, you are exposed to exchange. We cannot claim that authority doesn't know. If you actually, very often we take a position that information is of my subsidiary, I cannot provide it to you. Don't we take? In our assessment, it's a foreign subsidiary, I don't have any control over my subsidiary, I can't provide. It's a foreign holding company, I can't get the information which you want because it is not available. All those claims henceforth will become difficult because what you don't want to claim and submit, he will be able to get it through his channel of information. So you have to carefully think whether you want to provide or you don't want to provide. So these are new changes which have taken place. GAR, overarching tax curve, you will not be able to do much, and whatever you plan, it can reorganize, recharacterize, restated. All those powers are there with the regulators today, and tax benefits as a driver is one of the main purposes. Then you can be visited with GAR and you will be visited. So actually we are in a greater environment that the investment flow which we thought of can be recharacterized. Even the transactions which we conclude may be recast by the tax authorities. Aggressive tax positions, there are many jurisdictions which say that you must disclose the aggressive tax positions. Either you should disclose or your advisor will disclose. So there's an obligation to make a disclosure of aggressive tax positions. This position has been there in most developed countries already. India also may mandate that you must disclose aggressive tax positions. It's part of the BEPS agenda also, that you must disclose the aggressive tax positions. Public perception about reputation risk is the most important thing for most corporates. Most corporates don't like reputational risk. They don't. What we normally go through is the newspaper test. There are no more good tests because newspapers don't reflect any more news. But nevertheless, they are tests to be gone through, and therefore no corporate would like to be subject to a newspaper analysis of what went wrong. They would like as well to be dealt with a regulator than with a newspaper. This name and shame framework of government is enhancing. You find in the GST already there's a formulation that you can be named and shamed formally. In income tax also, the moment there's a search, they will leak the information to the press secretively, and you actually have a disadvantage on day one that you have got some kind of incriminating allegation without even actually finding to that effect. rigor in environment has gone up, higher empowerment to revenue. Now they are able to actually, you find, which is very apparent. Earlier, assessing authorities used to be less invasive. Today they are far more invasive. They are very aggressive. In fact, I don't know whether you had an opportunity to hear a revenue official yesterday. If you had heard him, you will find that even ordinary structures don't carry the what's called the conviction with the authorities today. They are very powerful today. And it's not in India, it's globally true. All tax administrators have become very powerful today. Power to arrest is embedded in the GST law, it's there in the income tax law too, under circumstances. They get visited very often. So the fact that it may be a small time make my trip guy who gets arrested occasionally and the Delhi High Court had to intervene, you find that these kind of arrests will be more often used to sense a deterrent against other assessees. E-governance, adaptation of technology, that's what our sir mentioned, that a faceless assessment, jurisdiction-less assessment, do you feel it will be successful or not is your question? In the long run, in an electronic environment where the return is electronic, where the submissions are electronic, and you are able to provide all the details which you want, you find that the environment will mature to that. Because I can tell you, I answer all my assessments from India for my US closure. I close globally about 40 countries sitting in India without visiting the officer most of the occasions. I visit the officers only to either for a goodwill, to say hello and have a nice chat with him, or to iron out final issues which may evolve at the final stage. But mostly they are e-assessments. So e-assessments work well in an electronic environment. When the return is electronic, the details are exhaustively captured in the return and the submissions are electronic. What it may fail is that certain obvious answers may not fly to the officer. You would have written few lines, you would think you have communicated, but actually the communication doesn't happen because he doesn't read the way you want him to read. That is the difficulty which will be there. That will get ironed out over a period of time with the objectivity of the questions they raise. Today the notices look similar to what they were looking in physical terms. Going forward, as they learn, the notices will look the way it should look, having regard to evidences. I think that's the way it will change. So let us bear with the difficulty for some time. E-assessments will work. It will bring a greater rigor into the assessment practice. Even today we are in e-assessment, but we know the officer. But a stage will come to the next level where we will get. Globally it's happening. I can tell you. There is an e-assessment procedure. You are able to answer most of the questions. They will be able to get it. Faceless assessment is what we do. There is a technology adoption, which is again an issue. There is a surveillance on today you buy a TV, immediately the officer knows you have bought a TV. You go for a holiday here, if you pay out of your credit card, he knows that you have spent a holiday here and he knows how much we have spent. So there is a surveillance which is going around the citizens on the transaction. Whether it's valid in law, not valid in law, how many countries will allow such kind of a privacy invasion, all those issues will evolve over time. Today, there is an excessive regulation and surveillance. In an environment of excessive regulation and surveillance, we must understand that the risks are loaded against you, and we must manage those risks accordingly. Financial accounting, most of the accounting has changed into valuation principles. Ind AS is valuation principle. ICDS is valuation principle more or less. ICDS, suddenly you find that you have got a set of new regulations overlaying the Ind AS, and said actually you got two sets of accounting if I get it. GST, it's also valuation principle. You find that valuations are now scored compared to regular historical accounting which we used to follow. So when the accounting principles are shifted from the tax basis of determination, you have got more risks to manage. Because what is stated in the accounting statement need not be your claim. Your claim is different from the accounting statement. Compliance systems, controls, they are always under change, they are always under difficulty. You are never up to date. Today, there was a time, with my long experience I can tell you, if I were to weigh the relative pros and cons, assessees had a greater advantage of knowledge, management, risk control and other things. Today I can tell you, it is the revenue department which has higher knowledge, higher controls, higher what's called ability to navigate the information than assessees are. Assessees are today vulnerable compared to the knowledge which department possesses. Not only the knowledge of your transactions, which they may know, knowledge of the domain knowledge itself. For example, how international tax should be assessed. We are talking of whether profit split is good or not. They are already agreeing on how profit split should be handled. So, we are in a debate zone. We are still thinking whether profit split is the right method or not. International community of revenue authorities are now already discussing as to how profit split should be properly handled. Okay, that's a gap between our understanding and their understanding. We will not be able to narrow down. Myriad of challenges, transactional taxes associated with anything which you do reorganization. Earlier, a merger used to be tax-free. Today, merger need not be tax-free. Because the NCLT may say, we have not looked into the tax aspects of merger, which department is entitled to look at. This is issue. So, any merger which was understood to be tax-free need not be tax-free. It can even, the scheme itself can fail at the point of NCLT itself today, because they may see what's called a tax advantage flowing out of the merger. Myriad of challenges for taxpayers and advisors. Base erosion, this was, I will take another 15 minutes, that's all. 15? That's it. 10:30, okay. He's been very liberal with me. So, now going forward, after studying for 2 slides, if I say last 2-3 slides essentially captured my thought process as to how I want to present the entire presentation. Rest of it is only nice pictures. We'll keep watching them, analyze, not do much of an analysis, but they are pictures make you remember as to how the transition is taking place, correct? Earliest structure, you had one parent company, say in India, you would put a holding company in a region, say Singapore or Cyprus or Mauritius or any other place, and you will keep a manufacturer, developer, you will keep a principal entrepreneur, and you got sales agent. This used to be the segregation of different organizations to earn profits. For example, the manufacturer will be a toll manufacturer, the sales agent will be paid a commission. So the principal entrepreneur in the foreign country will earn all the profits, which is the residue profits, which will constitute the dominant amount of profits, and that profit from the principal entrepreneur will be moved up into the holding company, and the holding company will hold it perpetually or redistribute it in the channel for next level of investments. This was the original model which people used to follow for many years. It worked well because the treaty framework supported this kind of a model. Little changes happened, people became a little more intelligent. The same old company, India has a holding company, say you will constitute a IP company to hold the IPs, you will constitute a finance company to make finances, you will have a manufacturing company, you will have a low tax principal company, and so on and so forth. So essentially the same model was further rejigged into specializations of IP company, specializations of finance companies, and the other functions of sales, manufacturing and entrepreneur being captured in a different jurisdictions. So same model with a smile. Now what you have done is now the profit which was embedded in the principal, you are now splitting it to IP profits, finance profits, and you have now get the residue profits in a different mechanism. This was the improved version which has been prevalent for the last 20 odd years, ever since globalization came. So with globalization, people thought we must split the IP profits, we must split the finance profits separately, and they kept the rest of the profits in the old format in which it was there. This was a new change which happened. Then technological companies became very dominant in the world space. In fact, today also you find the top few most valued companies in the world in the stock exchanges must be tech companies. Tech companies found a more innovative model. They felt that let there be multiple flows of royalty in such a way that the royalty flows by the time they come, we will hold the final royalty in one place, that it is tax free. For example, you look at, this is a diagram possibly of Apple. I will not mention it, but you can silently apply it, you can get it as Apple for a moment. So you can get it. It had a Netherlands BV. It's called double Dutch Irish sandwich, something like that they call it. They will place it in such a way that the royalties have multiple flows. At the point of origin, it will get shifted from place to place, and it will get parked in a place where it's least most tax efficient. So the effective tax rate of all these royalty payments collectively for the organization will be very minimal. You see the diagram, you will get the payment as to how the, for example, 850 of royalties get paid from level 1 where the sales happen to the airline company, and other airline company will in turn flow it into a Netherlands company, and Netherlands company will flow it into another airline company. So two airline companies get sandwiched between, one Netherlands company gets sandwiched between two airline companies, and the flow of royalties happen on that level. So this was one. With this structure, the company, which is a tech giant, was able to manage its aggregate taxes to less than 2-3% on this account. Okay, they had an overall tax effective tax rate very low, so they were able to do, because what is the value creation? The value is paid by the customer for what?
Right.
It is paid for technology. If technology is represented as the value creator, if what is the surrogate economic model for technology is royalty, you strip the royalty and keep it in a place where it can be maximized highest, and therefore you achieve a ETR which is lower. If the value for the product is technology, what is the main ingredient of technology in realization? It becomes royalty. Keep the royalty in such a place that it becomes minimum taxable. Automatically the entire value chain flows into the place where the royalty resides, and you will be able to carve out the value of the entire chain into minimum tax. It's a very simple thought. In thought process, it has got no brains, because even I would do it if my product is technology, it generates royalty. How to maximize royalty? This will be my thought process too. So, but how it has been executed, how well it has been schematically done, I think that is the beauty of the structure. It was given, Ireland gave it to them as a preferential ruling. It's not that they got it. Ireland gave it to him saying that you come, you do this, I will give you this concession, you take it from us. It was a preferential treatment which was given. So is the case with, say, Google and others. This is the other fellow, G Inc. Similar structure, technology flows and the how the license flows and how the royalties flow. This is a similar one. This is the e-commerce giant in the US. Amazon, yeah. E-commerce giant, and this is how he organized his structure at different points in time. You go through the structure leisurely. I am not here to prejudice your mind. I have got nothing. See, each structure when they are created are perfectly valid. I can tell you even today, if I were to defend them, I will defend them. It's not that I can't defend them. I will defend even after the change. Even after BEPS also, I will say they are good structures. All that I have to do is pad up the substance a little more. That's it. What has happened now is that BEPS came. Now there's a new concept called value creation. In technology, we understood two value creators. One, there was earlier, when you say IP we understand in ownership context as a legal owner. Anybody who owns legally, if you ask a lawyer, he understands only legal ownership. And he will implement all the contracts based on legal ownership, because he wants to reinforce legal ownership, that there is no infringement against legal ownership is the basis on which legal contracts are constructed. The fear of a lawyer when he deals with an IP is that there should not be any infringement. That is the basis of focus on which he constructs the contract. The earlier understanding is that economic owner, that don't forget the legal owner, he may be anybody, look at the economic owner, and whoever is the economic owner, give him the. So if the legal owner is in America, the licensed party is in say Singapore, we used to look at the economic owner as the one who had the license, and therefore we were looking at the economic owner as the licensed party. And any contract could create the licensed party. I can create a contract and say I am giving a contract of license to Singapore, therefore the economic owner is the Singapore party, and the legal owner is in the United States, the economic owner is in Singapore. So contracts could create economic owner. Now the focus has shifted to functional owner. That is, you must have a functional owner for an IP in order to derive a value. So the shift has shifted from a legal perspective of a legal owner to a tax perspective of economic owner based on concept. Now we have come to a functional owner of a particular IP. So what are the functions? You would have heard of this DEMPE function already. I have just marked it for you as a picture. You go through the DEMPE functions. This slide will capture how to perform DEMPE function exactly. While this is not a cure in itself, but you will get a reasonable one slide comprehension as to what is DEMPE, how to implement it, how to understand it, how to execute it. Okay?
We go only for intangibles. DEMPE we have to use only for intangibles.
Because in value creation, the only change which has happened is that you have to overlay the IP, what's called ALP with value creation. So in the first slide I talked about supply chain overlaid with intangibles, valuation now overlaid with
DEMPE.
So all slides are interlinked. I am like Modi. I don't give any statement without interlink. Okay, two case studies. I'll just leave it for you. Essentially, I will not discuss the case study. Please go through in your nice leisure whenever you get the time. This is what's called the cash box mechanism, which was prevalent. That is, you create an IP company, you create a R&D mechanism, and you have a market mechanism. So you got a distributor, you have got an IP company, and you have got a R&D related services. For R&D related services, you pay a cost plus mechanism. IP company sits elsewhere, and the marketing intangibles are generated elsewhere. So you find that multiple models are created. This is a very typical offshore model which used to be evolved earlier. The only difficulty now is that parent company mere funding and assuming of controlling related. So the concept today is that you must not only have the ownership of an asset, you must have the capability to manage the risks. You must have the capability to own and manage the risk of a capital asset. So intangible, if you don't have the ability to capable of owning and managing it, that is contractual owning. So you find that the risks and rewards will currently change. Now IP company earlier used to be entitled to a R&D company used to be entitled to a cost plus mechanism of reward. Suddenly you find that it is the one which is creating the IP, and that becomes the functional owner of what's called in DEMPE. It would do the development, enhancement, and those kind of features. They have a higher value attribute than what it used to earn earlier as a mere owner of a IP. So very hypothetical situation. Don't look at the figure as they are sacrosanct. This may not be the result. Pre-BEPS, the IP company could get 540 rupees as a residue profit, though it was only contractually owning. Now in post-BEPS, it will get only 10 rupees as profit. Out of 1000 rupees of revenue, IP company earlier could get 540 rupees as profit. Now in the revised BEPS mechanism, you find that it will get only 10 rupees of profit. So what happens is the remaining profits gets distributed into other channels of the web. This is a real exaggeration actually. I may look at 540 how it can become 10, but in reality you test the concept a little more closer. You may not agree with the multiplier, you may change 10 into 15, 15 into 10, but 10 may become finally 20, 20 may become 30, but you are not going anywhere near 540. This change, if we don't recognize and quickly align our profits, we will be in trouble. Then social media, all of us are on WhatsApp, Facebook, everything, correct? Do we pay anything for that? Nothing, all free. No revenue coming from us, correct? So nothing, we don't pay anything, but you are users. But is there a revenue for the IP holder? That's a revenue. So it's called social media. There's a mass of users. They don't pay anything for that. The economic value comes from some other kind of an economic equation, and you find that the person who is paying for the platform is different from the person who is using the platform, and therefore how do you find out a result? That you will be able to find a due allocation. Something can say, is there a data, my date of birth, how it becomes important for Google? As standalone, it has no importance. Correct? 16th March 1960 has no value. because it is useless data. But if it says that those who are born in the month of March drink a lot of water, then they will find that to anybody who is born in the March, they will keep on selling water bottles to them. Correct? So aggregation of data becomes a value. Whether it constitutes a value on its own or is a value which they derive through a manipulation. On a standalone basis, they don't constitute any value. Through manipulation of those data, you get a value. That value should be given to the end user or it should be given to the manipulator. These are the conflicts which are there in the marketplace today. And this case study, which I have left it with you, is about this conflict only. Whether you will give the value to the end user, and my next speaker will talk about user-based significant economic presence also. This slide maybe actually would have been good enough if I had spoken after this session, but still I will request you to apply this model after this session and see whether it makes sense to you on that score. Okay? This is the way it's been considered. So you have to know suddenly a complex world has come. Not 1 rupee you have paid from India to the platform. He gets revenue from somebody else. But still you find that the government authorities are saying that you must pay a share of your revenues into me, profits into me. What is this new model which the governments want to claim? Because nothing has arisen from India. No money has gone out of India. The fact that he is earning money outside India is suddenly irking me, and I want to say you must pay a part of your profits into India, and that is not a mere profit because of ordinary cost or something. It should be a profit split based on users. This is the new anomaly or new conflict which I had. Okay, new risk. What I see in certain user risks will also be true, because what is user as one base can be an amount as another base, employees as another base. There are so many factors which are not normally thought of you as economic contributors. You have a peon in Singapore and a managing director in India. Headcount wise, both are the same, correct? So the profit should be equally allocated. New distortions are taking place. Okay? That's my presentation for you. We can take questions for you.
Sir, I have a question. Sir, the new law is coming with the data of India, okay, required to be dealt only in India.
Correct.
So after that, how things will change for all these social media, what is companies, where they going to place a server in India, where they are not giving only data of India, okay, they may keep data of more than the what is called one country. So how the things will change? Just a small one.
Data in India is a regulatory requirement. It doesn't mean that the person who is having the data will not manipulate it for his business advantage. One is the location, the other is the manipulation. Location in India is for regulatory framework that they have access, they will be able to control it, they know who are the users. It is a I will say it's a security issue, if I may come. That is okay, that's fine. But still the issues of taxation on who the users are, how the data constitutes data of value to him. Is there a data now the new field of valuation is emerging, is that you and I should learn quickly, is that valuation of data. Valuation of businesses we have done. Now we must learn valuation of data will become the most wanted line in the next level.
But this will not create a forceful creation of PE in India. So right now I am keeping my
That's
Singapore, okay, now you are...
That is another sense that may create a PE. I will leave it to my next speaker to speak, because he may touch upon these issues. I thought he will, and that's why I left it. It can create a PE technically because the users are in India. But even without location also, is there a dispute that the users are in India? So just because it's located in India, it's only a formal recognition. That's the ability to track and monitor it. You have to presume that global firms will not misstate facts. They will state that there are so many users in India. I don't think anybody will understate that part of it.
So there are many companies in India, across the world also, which take tax position. And now there's a new accounting standard which has been prescribed, where you have to the accounting for uncertainties on tax disclosures. So
can you just shed some light on that standard and how it will affect going forward? If for the assessee, will it be detrimental because the department may look at it differently? And
UTPs were always there. We used to mildly call it as provisions. Now they are called formulous uncertain tax positions. For the only reason, what is uncertain tax positions? That you have made certain claims in the return, but your book provisions are higher than the claims in the return. Correct? That means you want to be conservative in books, aggressive in taxes. Correct? And that may also flow, some of them also may flow into what's called aggressive tax positions as far as your claims are concerned. But I'm telling you, there is nothing called confidentiality anymore. Globally, under IRS regulations, they can call for your provision workings. They can call for your provision workings. You cannot say, no, I will not give it because that is my personal computation. You have to give your provision workings. You have to give positions as to why you feel that the position you have taken in the return is not good enough for the books to be retained as provisions. All those issues are there. That's why I'm saying this game is no more about secrecy. This game is about playing it head on, having the required competence and confidence to place it before any authority and say that I'm right there, I'm right here. That is the confidence you require actually.
Once again, thank you, sir, for taking us through this tax risk management. Of course, in future, as he said, there will be a lot of risks, both nationally and internationally also. So, you have given glimpses of tax risk management so that we can be more vigilant in filing our returns or even during assessments. On behalf of everybody present here, I profusely thank PV Srinivasan, sir, for coming here and sharing his wide experience. Call upon Mr. Sheshaji sir to come forward and hand over a memento on behalf of everybody here.
What was this then?
That was a bouquet, sir. He will give welcome drink and also will give.
I'll take this book.
Yes. So, members, I think most of you